Hello everyone, and let's get started. In this webinar we will continue talking about self-coaching. In previous webinar on this topic we have been talking about phases of trader development, about competence and expertise and difference between them. Also we have touched the topic of trading discipline, which is very big and it is impossible to cover it in one single webinar. In this webinar I will pay attention to analyzing numbers, which is trading performance. Numbers can speak louder than words, especially in trading where results are measured in numbers. And also we will continue talking about psychological issues such as negativity bias, about behavioral triggers, and other important aspects of trading psychology that every trader has to know. I invite you to listen and make notes if necessary. Most of ideas discussed in this webinar were somehow used for trading either from me or students of my educational groups. Okay, and traditional disclaimer. Before we start, let's take a quick look at this slide. Please be aware of financial risk associated with trading. Information in this webinar is provided for educational purposes only and by no means can serve as a trading or investment advice. You will have full responsibility for your trading decisions, so we encourage you to test any of ideas or concepts that you will hear. Okay. When we talk about self-coaching, we can talk about several points. First of all, of course, it is analysis, research, and understanding of the market. It is possibly the most popular thing among traders. Too many traders focus too much on analysis, trying to predict the market. Though I'm not saying that it is impossible to predict the market from time to time, but most of the time markets are way too uncertain, and we have to wait until setups will become more clear. Patience gives real edge for a trader. And if we were able to read the market like a book every day, every single hour, every 5-minute bar, it would have become much easier to capture profit from the market every single day. But we know that really good opportunities don't occur too frequently. And the reason for that is that markets are not very predictive. And the second thing is skills of risk management. I don't mean that trader has to be able to calculate the position size. Risk management is more complicated thing. Well, of course you have to know how to calculate your position size, but risk management is something more than just that. Good risk management is ability to constantly evaluate and re-evaluate the odds, and markets are influenced by many factors such as news releases, activities of other markets, time of the day, and etc. Ability to execute trades correctly is also important. This is point number 3, which is trade execution. Here we talk about discipline, patience, and risk control. And one of the most important things is getting feedback from the market. Now, why feedback loop is so important? You know, trading edge is not a constant. It is a variable, and it can disappear over time. So to be a profitable trader, to be a successful trader, you need to change with the market. Because markets change, but successful traders, they remain to be successful. And you can only change if you analyze your trading performance. When you read your own entries from a trading journal and compare it with how market really behaves. And finally, of course, you need to build mindset of a successful trader, which includes emotional intelligence and self-awareness, which is very, very important. I paid some attention to this topic in the previous webinar, and I'm going to tell a few more words about this topic in this webinar. We will also talk about mindset issues here. Now let's remember two types of thinking in trading, which are mechanical trading on the one hand and discretionary trading on the other hand. These two approaches are different because theoretically when you trade mechanically you are not about to face any psychological pressure in theory. In practice, of course, you face this psychological pressure. And discretionary trader can be more flexible. I will not pay much attention to this topic because I was talking about that in previous webinars. I just put this slide to remind you of two approaches. We will talk more about discretionary trading today. It is not about mechanical trading. We will talk about improving performance for discretionary trader. It's been said that you can manage only things that you can measure. There are basically two ways to assess your trading. First is focusing on numbers or focusing on trading performance. You can analyze your trading performance capturing important information from your trading log or a trading report. Then when you compare this information with what was happening on the chart in real-time market, you get the idea of your real behavioral patterns. It is very useful to analyze numbers because numbers never lie. They can tell you a much better story than anything else. It is a story about your hidden patterns of strengths and weaknesses. And the other side of the coin is psychological patterns or psychological approach. When you don't focus too much on the price action, you assume that your market understanding is basically okay, but you switch your attention from your own best interest from time to time. And your task is to get back to your own best interest. Sometimes traders say that keeping a trading log is a way too boring process. And when I was at early days of my trading career, I was using Microsoft Excel for analyzing my reports. I was putting numbers in Excel every day and analyzing it during the next day or at the end of the week or even at the weekends. Now there are some web services that allow to do that in automatic mode. Yet if you are not trading very aggressively and actively, I would recommend you to do it manually. It can be a really valuable experience. Of course it is a bit of work, but I would tell you that if you really want to change your trading and turn your trading around, you will have to work hard for at least some period of time. It is not so easy to change your habits, beliefs and behavior. On this slide you see a sample of a trading log. Of course it is not useful at all when you see such kind of trading log because you don't see anything here. It has to be processed and filtered. It is just a log and it is very difficult to capture anything from this report except that biggest loss has occurred when trader had increased his trading volume 3 times when he was trading 3 lots. And that's all we can capture from this report. So to capture useful information, you will have to somehow process this information. What do we really want to capture from this log or this report? First of all, it is average number of trades per week, month or any other period of time. Of course, to have these statistics, you should know what is sort of a norm for your strategy. And not only number of trades is important, but also you have to know type of the market conditions which made you increase or decrease your activity. Maybe it's not market conditions, maybe it is your previous performance that made you trade more actively. So you have to know what is the reason for your increased activity, for your possibly overtrading. And secondly, it is winning or losing streaks. Sometimes it is difficult to find correlation between good trading and short-term trading performance. For example, if you employ trend-following trading systems or algorithms, you can have up to 10 or 15 losing trades in a row, and still it will be profitable trading by the longer-term period. But for short-term trading, and especially day trading, good trading more often correlates with short-term positive results. You will likely have winning streaks if you read the market correctly and make good trading decisions. And on the other hand, losing streaks can be an indication of inappropriate decision-making process. It is an indication that we will more likely have to change something in our trading, whatever it is. Maybe it is our trading ideas, which are not very good, or trade execution, which is not accurate. And of course, we have to monitor our position sizing if we violate our risk management rules, or if our position sizing is incorrect. It is often an indication of incorrect execution. And of course it is timing. If you find that your losing or winning trades gravitate to certain hours of the day, it may be the sign that possibly you try to trade within periods of low volatility. I will show you later in this webinar how it works one more time, but timing is very important. Also, you can notice that some of your trades gravitate to some day within a week, I mean some profitable trades. For example, you trade more profitably in Wednesday or Thursday, but possibly Mondays can generate losing trades in the whole distribution of your trades. And the first thing worth analyzing is trying to compare your best and your worst performance. And you want to see what was happening in the market at that time. You may find that your overtrading occurred when day was neutral. It is a very popular pattern. For example, when market finally has not shown any signs of action, but you notice that you were generating much activity. I will say that it can be easily explained because market generates many tests and fake movements within such a day. You may decide that now market is ready to go and I will step in. Then it reverses, then you re-enter again, and finally you think that it will be very silly to miss a final breakout and try to re-enter several times more. And of course you may find yourself getting in and out, in and out, in and out all day long. And it may lead to severe loss or severe drawdown if you don't have any daily loss limit. That's why I tell you that this kind of behavior is very popular. And there are many cases, or at least I have seen many cases, when trader loses money within neutral day when nothing really happens. It is very strange, but many traders increase their activity within neutral days. And they decrease their activity within trending days, which is also very strange. Now let's look at the example of yesterday's trade. I was trading the breakout momentum trade using this bar, using this initiative bar or a candlestick, breaking the level 118.45 or so, I don't remember the exact level. And notice what has happened after that. We see 1, 2, 3, 4, 5 30-minute bars, or more than 2 hours of no continuation. So market is telling us that this day will possibly not be trending. And I have exited this position without any loss, or even with a few pips of profit. And you see that finally this day is absolutely neutral with minor decline. And if I insisted on trading within this day, if I would try to enter a short position here, or let's say long position here, or even short position here again, well, this trade would have become profitable one, but it is not a day trade, it's a swing trade with position holding overnight. But eventually I would have generated 3 to 4 or even 3 to 5 losses in a row. And you see that this day eventually is absolutely neutral, but there are plenty of opportunities to generate many losses within such a day. So neutral type of activity can finally lead to numerous rapid breaks with no continuation and can lead to overtrading. It is bad market condition for breakout momentum trade, and that's why you should have daily loss limit and limit your number of attempts when you see such kind of action. It is psychologically hard to miss a good trade, but good trade is not your responsibility. Do not fight for the good trade. Fight for limiting bad ones, and your trading will turn around. As for trending days, traders also tend to be very conservative, if not to say risk-averse, when they see fast-moving market going in either direction. And traders often prefer to take modest profits, leaving too much money on the table. That's how trading psychology really works. Traders are aggressive when they have to be risk averse, and they avoid risk when they have to be aggressive. And I want to show you once again an example of trade from American dollar versus Canadian dollar made in January How do you think, how many traders were really able to hold this position for at least 1 week? I have received a few emails from students of my educational group who were trading the breakout from this trading range, and they have captured 3-to-1 profit-loss ratio here, so that is pretty successful. But in fact, market conditions were very strong trending, and we should have held this position until it reaches target. So you see, it requires a bit of patience, and you have to be more aggressive. So you may buy some here, then also add to your position here, here, and finally close your position at the target of 1.46 or 1.4550, which was my target. So if you see trending days in the market and at the same time you were not trading aggressively or you were not involved in the action, and if it is a pattern, if it is a repetitive pattern, then you should pay attention to that. Notice what has happened before. Possibly you need to improve your analysis to be able to capture such trending moves, but you need to learn how to capitalize on trending days or trending moves, because it's the easiest way to trade, really, because volatility on the pullback, on the side of the pullback, is very low, so you can place really small stops and you can earn decent profit-loss ratio, and market is going very quickly, so it is a level of comfort for a trader, and you can achieve nice profit-loss ratio and make good trades, taking profits pretty quickly. Now, if you put some time and effort to analyze your frequency of trades, especially when these trades gather into losing streaks, you may find that sometimes you may be too aggressive once you see relatively high or low price. I call it the high-low price fallacy, and I described this behavioral pattern before in a webinar named Traps of the Market. I would recommend to watch this video. It is available on channel of Exness here on YouTube. I've seen too many times traders doing the same thing over and over again. If they have seen trading range before, and if this trading range was pretty elongated, they tend to be more and more aggressive when price emerges from this trading range. For example, like it is shown here. But it is absolutely wrong as wrong can be, because when price emerges from a trading range, it shows really the destination of an auction. And it is a way to wipe out the account completely over a large period of time, because if you do like it is shown here, you place short position, you add to your short position, and finally you add more and more on the rising price, finally you could be wiped out from the market. And I have seen too many accounts lost when traders employ such kind of thing. It might be the rising market or a falling market. They try to buy bottoms, or they try to sell tops, whatever it is. But when they see high price or sort of a high price, they try to sell more aggressively. When they see low price, they try to buy more aggressively. That is a pattern that you need to eliminate from your trading. It is also a very popular pattern. So answer the question, do you tend to open more short position against ascending trend or more long position against descending trend? Sometimes losing streak occurs when trader is right about the market action in whole, but still he can't execute his trade correctly. The most popular example is the following. Market is trending and trader decides to trade in the direction of this trend, using small pullbacks, getting stopped out very quickly, only to see that market is about to renew highs, so it is going in the predicted direction. It means that active phase of the auction might be already completed and market goes sideways with a trending component. Traders try to capture pullbacks acting as if trend was still in active mode. They want to see something like that. But it is already mature and trader has to treat it as a trading range and trade within this range. But of course in the direction of the previous trend. filtering his trades and searching for trades or accepting trades only in the direction of the trend, because it really helps to filter bad trades and achieve better results. Do you remember that the most difficult way is capturing a reversal and the easiest way is trading in the direction of the dominating trend? When you analyze your number of trades, it can also be helpful in case you know your typical distribution of results, your average number of trades that is good for your trading strategy. For example, in my trading, it is okay to have 20 to 30 trades a month because I'm not a very active day trader. For other traders, it is okay to have 50 to 60 trades a month. And if you make significantly more trades or less trades than this average number, it can be a sign of overtrading or insufficient commitment. And of course, it's easier to analyze your performance if you are a short-term trader than in case you employ trend following trading methodology, because you can have many losing trades and eventually they are covered with small number of successful trades. And it is not representative to have many losing trades here. When you trade in short-term perspective, when your targets are average, so your correlation between good trading and short-term trading results is more prominent. And finally, you can build distribution of trading results for some period of time within a day or even for some day within a week. Of course, you may find no useful information, but sometimes you can see that most of your successful breakout momentum trades occur during first 2 hours of US session, when new financial institutions come into the market, new banks, new players, new information, including economic reports, economic releases, and it sometimes can give you a clue what to focus on. For example, I've improved my results in day trading when I filtered my trades and decided not to trade in the mid-session of Europe. And of course, you can capture that some of your days may be more losing than other ones. For example, when I was analyzing my performance in early days of my trading career, I have noticed that my results for Monday were more losing ones than for any other day, because I had a belief that trending days have to occur at the first day of the week. I don't know where I have taken this belief from. When I started to trade less aggressively during Mondays, I have improved my trading results. Now I want to say a few words about winning mindset and how to build it, because it is an important part of self-coaching. We have touched this topic in previous webinar, but I want to go through it once again and add a few points. First of all, it is anchoring in the now moment, which includes developing emotional intelligence and self-awareness. Then it is ability to sustain positive attitude. It is not about positive thinking. It is about paying more attention to your strengths than to your weaknesses. It is very important because we build our expertise relying on our strengths, not weaknesses. You can't be successful just getting rid of something. It doesn't work that way. You have to know what you do right and do it more and more and make an edge out of it. And finally, you can develop as a trader using behavioral approach. It is much easier to anticipate your response than to deal with consequences. When you know how you are about to react in certain conditions, you will keep your internal observer awakened and sustain decent level of self-awareness, which will increase your level of discipline. I will not talk much about keeping a journal. I stressed the importance of a journal in previous webinar. The basic rule is you become neutral to what you are writing about. At the moment of writing, you are not a trader, you are a self-coach. And this position contains much resource. Now, what is about negativity bias? It is a very interesting feature of our brain that probably roots in the early past, when our ancestors had to be very attentive and recognize danger very early, being able to escape or fight to protect their lives. Our neocortex is pretty young in comparison with the reptile brain, which is very old. So many of our instincts lie in the reptile brain, and we tend to focus more on negative information as a result. Something that we treat as a danger will automatically get inside our focus, grabbing more and more attention. In trading, we often treat losses as a danger, especially if we trade aggressively, taking significant risks. And it explains a lot. We tend to drop our positions very quickly. We tend to be risk averse when there is really good opportunity because we don't focus on the good. We don't focus on successful setups. We don't focus on strengths. And we have to develop this ability. The good news is that we can consciously focus on the right things. Before the day ends, notice and write down in your journal what have you done right. Even if you eventually lost some money, there are definitely things that you have done right. Write it down in your journal because it's very important. You need to focus more on the right things. It's nothing wrong about that because you will not focus less on mistakes because your brain will not let you do that. And finally, you can work on your triggers. What is a trigger? It is an event that sort of pushes the button inside of your brain. And sometimes people who give up drinking and smoking are advised to do the same. If you notice any repetitive pattern, I mean destructive pattern in your trading, you may notice what is the trigger for such kind of behavior. It may be physical condition, it may be volatility that suddenly appears in the market combined with some level of tension or excitement. And if you know that you tend to react on volatility, you will be much better prepared when next time you will see big trending bar with elongated body. So if you have such kind of table, you will be much better prepared to the event. And of course you can grade level of your emotional pressure in the column reaction. For example, here I have put several numbers, 7, 8, 7, 6, so it's pretty subjective. You can put any number of your choice. It means it just measures level of your emotional reaction. And in the column response, you may put your action that you typically make. For example, you re-enter your trade after being stopped out, or you overtrade, or you trade too much when volatility increases, or you get out too early from your positions when you have paper loss, when you are losing some money, or for example you do some unplanned trading if you lack in time and have read some analytical report or have heard some external opinion. So you can explore yourself, because knowing yourself is very, very useful for trader. If you know yourself, you may even have not enough understanding of the market, but you have understanding of yourself, and it gives really the edge. And the majority of traders, they don't know themselves. They don't know what to do. They don't know what to expect from themselves. They can't anticipate their own response, and you can be one step ahead of the rest, be one step ahead of the crowd. Okay, thank you for watching this webinar. We will continue talking about this topic in next webinars as well, and with that I'm going to finish this webinar. I hope it was useful, and if you have any questions or comments to this video, you can leave it below here. I will do my best to answer all of your questions. Please be specific to receive a good answer. See you in the next video.